Okay, let's unpack this. We're going to dive into a corner of the market where really deep and specialized knowledge is the only path to finding real value.
Yeah, absolutely.
And we're focused squarely on FTAI Aviation today, ticker FTAI. This is a company that's going through a transformation so significant that it promises to unlock massive pools of capital.
It absolutely does. I mean, when you're looking at a business that isn't just radically changing its core operations,
Yeah.
you know, moving from leasing into this high-margin maintenance world,
Yeah.
but is also structurally rebuilding itself for institutional capital, the complexity level is just incredibly high.
It is.
You can't just read the headline on this one. You really need to understand the gears turning beneath the hood.
And that's our mission today. We are doing a forensic deep dive. We're using sources from CEO Joe Adams' own commentary, expert analyst reports, and of course the hard numbers from the Q3 2025 earnings. We want to give you the shortcut to understanding FTAI's unique vertical integration, its structural shifts, and why a company that was once, frankly, a messy industrial conglomerate is now a prime growth target.
And we have to start with the market signal that, for me, really validated this entire strategic shift.
Okay.
It's the movement by Oaktree Capital Management.
Yeah.
This isn't just a standard institutional trade. This is Oaktree. It's Howard Marks, who is legendary for his two-level thinking discipline. When Marks moves, we really need to pay attention.
And here's where the history gets really interesting, because Oaktree has a past with FTAI. They were disciplined sellers.
They were.
Sources indicate they sold off their previous stake, roughly between late 2023 and early 2024. So why was that initial move so important to understand?
Well, Marks' discipline, it dictates that you sell when an asset has pretty much achieved its full intrinsic value.
Or the margin of safety is gone.
Or that protective cushion has just evaporated. The initial sale was likely classic profit-taking. I mean, the stock had run up quite a bit, and from Oaktree's perspective, the risk-reward just wasn't there anymore.
Relative to other opportunities, sure.
Exactly. They viewed it as having reached peak value for its old structure. That's the key part.
But then we see the pivot. In Q3 of 2025, Oaktree files to establish a substantial new position. They buy 585,175 shares.
It's a big buy.
A very big buy. The stock was trading around $140 a share at the time of that filing. That's a high price point, especially compared to where they might have sold out just months earlier. So wait a minute, if they sold high, why are they buying back in now, possibly even higher? Isn't that just chasing momentum?
And that's the genius of that second level of thinking, which is exactly what we need to address here. It's not about the momentary price. It's not a dip or a rise. It's that the fundamental valuation itself has shifted. Oaktree's reentry is a signal that the company's structural and operational fundamentals have improved so significantly that the calculated intrinsic value of the business today is just miles ahead of the intrinsic value they sold a year prior.
So the price might be higher, but the value, the actual future expected cash flow stream has expanded even faster. That's what justifies the reentry.
Precisely. And the major corporate event that triggered this, according to the sources, was the successful final closing and, importantly, the upsizing of their Strategic Capital Initiative, or SCI.
We'll get into that.
We will. That, coupled with continued execution in their parts manufacturing approval process, the PMA process, it tells us Oaktree now believes FTAI is a fundamentally different and much more valuable company than the one they exited. It validates this new asset-light model we're about to explore.
All right, so let's jump straight into the mechanism designed to unlock all this new value, the structural catalyst. FTAI, as we know it, stands for Fortress Transportation and Infrastructure.
Yeah, a bit of a mouthful.
It was a classic, sometimes messy industrial conglomerate. What did that actually entail?
It was a holding company for just incredibly diverse, capital-intensive assets. You had infrastructure, things like rail operations, certain energy assets, ports like the Jefferson Terminal in Texas, and then completely disconnected from all of that, you had the aviation leasing business.
And it operated as a pass-through LLC.
Right. Which brings us to the biggest structural anchor on its valuation, the K-1 tax form.
Ah, the dreaded K-1. For an individual investor, that's often just a headache at tax time, right? It adds complexity you just don't want to deal with.
It is, but its impact is far, far greater on institutional capital.
How significant is that barrier, really?
It's a profound bottleneck. I mean, it effectively shuts FTAI out from massive pools of investment capital. Index funds, for example, which account for a huge and growing portion of market flows. They typically cannot own K-1 producing entities.
Just because of the administrative burden?
The administrative and compliance burden, exactly. You're talking about foreign tax issues, state tax issues, regulatory headaches that big asset managers are simply unwilling to inherit. It's a compliance nightmare for them.
So this is not just a minor technicality. The K1 structure is actively restricting the buyer base for the stock.
That is the key takeaway. Sources suggest this structure blocks an estimated 40% of potential market flows.
40%. Wow.
Nearly half the institutional market.
Yeah.
And beyond just the index funds, many large, long-only institutional funds, pension funds, endowments, they have internal mandates that strictly prohibit investing in K1 entities.
And even on the retail side, right? Platforms like Robinhood.
Even there. They often limit or outright bar trading in these instruments because of the complexity. All of this just suppresses investor demand and, ultimately, the valuation.
Which brings us to the planned solution. The major catalyst management has been pushing for the structural split and the conversion.
This is the floodgate opening. FTAI intends to split into two separate, much cleaner SEC C-Corps.
One for aviation, one for infrastructure.
Pure plays. They're aiming to complete the necessary filings by the end of this year, with the split potentially finalizing in, say, Q1 of next year.
The operational argument makes perfect sense. I mean, there's zero synergy between running a Texas oil terminal and leasing engines to Ryanair.
None whatsoever.
But let's look at the financial logic of the split. Why did consolidating the two businesses actually obscure value?
It's fundamentally about asset maturity and leverage optics. Infrastructure projects, they're typically very slow-burn investments. They require heavy upfront capital spending and debt deployment years before they become cash flow positive.
Right, before they generate any meaningful EBITDA.
And when you mash that slow-burn, debt-heavy business together with the aviation side, which is already generating robust, immediate cash flows,
it just makes the whole thing look worse.
it makes the entire combined entity look significantly more leveraged and less efficient than the aviation business actually is on its own. The split creates two pure-play companies. Infrastructure investors get a clean look at the long-life, steady assets.
And aviation specialists can just focus on the growth story.
Exactly. They can focus cleanly on the MRE growth story, free from the drag of all that early-stage infrastructure debt.
But let me push back a little here. Let's introduce some friction. If the infrastructure side needs all that debt, is there a risk that by separating them, the new infrastructure company loses the benefit of FTAI Aviation's stronger cash flows?
That's a valid concern, and it's something they've definitely thought about. The sources indicate the primary goal here is maximizing the valuation premium on the aviation side. The conversion process is designed to allocate the existing debt appropriately.
So pairing assets with specific financing.
Right. But the main point is that the aviation entity, the high-growth MRE platform we're focused on, becomes this clean, scalable, high-multiple pure play. And most critically, the conversion removes the K1 bottleneck from both entities, attracting that massive new institutional buyer base we talked about.
So once the K1 is gone and they become C-Corp, what does the historical data on similar corporate conversions tell us? What happens to the stock?
The historical precedent is overwhelmingly compelling. It's why institutions are watching so keenly. The sources cite analysis of similar conversions. Companies like Apollo, Carlyle, even New Fortress Energy, another former Fortress entity.
And the performance?
On average, these stocks dramatically outperform. Across the analyzed group, these stocks outperform the S&P 500 by about 20% in the 12 months after their conversion.
20% outperformance.
And what's more, every single company in that analysis set saw outperformance. That points strongly to a causal effect. It's driven by removing that structural barrier.
And I imagine liquidity just jumps, right? Which is crucial for index inclusion.
Absolutely. Liquidity, the ease with which large funds can trade shares, saw an average jump of 107% in daily trading volume.
Wow, more than double.
It's a huge jump, and it's critical because it signals the return of that institutional money that needs both volume and stability. The increased liquidity supports higher valuations, it reduces volatility, and it facilitates index inclusion. This structural catalyst is, I'd argue, the biggest, most immediate factor justifying Oaktree's reentry.
Okay, so the structure is the locked door, and the split is the key. But let's look at the sophisticated engine inside that door, FTAI Aviation Limited. This is much more than just a typical leasing company.
Rochmore.
What is its core specialized identity?
Its core identity is as a highly specialized outsourced provider of engine maintenance, repair, and exchange. They brand it as MRE.
MRE.
Right. They operate deep within the aftermarket sector, and they've realized that engine maintenance, not the initial purchase price, is the single biggest, most unpredictable, and most complex operational headache for any airline.
And their strategy is all about specialization, right? They aren't trying to fix every jet engine out there.
No, they are laser-focused on the two most common engines in the sky. They specialize almost exclusively in the CFM56 and the V2500.
The workhorses.
The absolute workhorses of global travel. Together, they power the Boeing 737NGs and the Airbus A320ceos.
Let's put some numbers on that dominance.
Okay, so the CFM56 alone, that accounts for an estimated 40% of the world's commercial fleet. We're talking about roughly 21,000 engines in service.
That's a huge addressable market.
It is. And the V2500 adds another 11% market share. And critically, these fleets are mature. They're moving out of their expensive cradle-to-grave, power-by-the-hour contracts with the OEMs.
The original equipment manufacturers, like GE.
Right, DE, Safran. And they're migrating into the independent aftermarket, where cost efficiency is everything. This is FTAI's target-rich environment.
Okay, let's walk through the actual engine exchange process, what the sources call the spread business, because this is how they monetize that airline headache.
It starts by acquiring run-out engines. These are engines that are either near the end of their usable life, or they have limited flight time left before they absolutely require a major multi-million-dollar maintenance event. FTAI buys these at a discount.
And then they essentially take on all the risk and the complexity.
Exactly. They bring those tired run-out engines into their own controlled network, their facilities in Quebec, Miami, their partners, and they perform a complete high-quality rebuild and restoration. And they're maximizing the use of their proprietary cost-cutting parts, which we will definitely get to.
So once it's restored, how does the airline benefit? What's the customer offering?
The flexibility is the key here. Airlines can buy the newly rebuilt engine outright, they can lease it, or, and this is the most common, they can execute a swap. They exchange their run-out engine for one of FTAI's ready-to-go engines.
It's outsourced certainty.
That's a great way to put it. Instead of the airline enduring, say, 6 months of unpredictable downtime and repair costs, they do a rapid swap, and they get their plane back in the air, making money.
It sounds kind of like swapping a server blade in a data center instead of shutting down and disassembling the entire server rack.
That is a perfect analogy.
You keep the high-value asset, the airplane, operational.
You're minimizing downtime. The airline is avoiding its single biggest operational and capital scheduling headache. And that value proposition has resulted in them signing up over 100 customers for this MRE offering in a very short amount of time.
The sources really emphasize, though, that the real differentiator is that FTAI thinks like an owner of the asset. That's a huge contrast with traditional MRO shops.
It's all about incentive alignment. FTAI owns over 600 engines. I think the Q324 filing said 442 CFM56s, 145 V2500s.
Yeah.
When you own the engine, your internal incentive is to perform the fastest, cheapest, highest quality repair possible.
Because you want to maximize the asset's lifespan and its value on your own balance sheet.
Right. Now, compare that to a traditional third-party MRO shop. They're performing work on an asset owned by someone else, the airline, or a different lessor.
Their incentive is to maximize billable hours.
Maximize billable hours and parts usage. They actually have a profit motive for complexity and duration. FTAI completely reverses that dynamic. By owning the engine, they're constantly driven toward efficiency, vertical integration, and cost reduction.
And that focus has translated into real market penetration, a jump from 0% market share to 9% of a $22 billion aftermarket in only 4 years. That is rapid.
It is incredibly rapid.
Yeah.
9% is a crucial number. It shows they validated the model, they've achieved escape velocity, but they are still small enough, below that 10 or 15% threshold, that they haven't yet provoked the full, aggressive, competitive retaliation from the major OEMs.
They still have runway to grow?
A lot of runway. Their stated goal is to capture 25% of this market.
Okay, so let's dig deeper into how they actually achieve those superior margins and that rapid growth. The platform seems to rest on 3 key pillars that form a powerful, defensible, competitive moat. Pillar 1 is PMA parts integration.
This is the massive cost cutter, and it's the hardest advantage for any competitor to replicate quickly. PMA, that stands for Parts Manufacturer Approval. It means the FAA has certified a generic equivalent part as being equal to or even better than the original equipment manufacturer part.
But they're not going after simple, low-cost parts. They're targeting the single most expensive section of the engine.
Exactly. They are targeting the high-value, high-wear hot section of the CFM56 turbine. This area is exposed to just phenomenal heat and stress, and the parts are notoriously expensive. For decades, the OEMs held a near monopoly on these complex components.
Which allowed for what the sources call monopoly pricing.
That's exactly what it is.
Right.
And FTAI bypasses this through an exclusive, perpetual partnership they have with a parts manufacturer called Chromaloy.
Let's quantify the benefit of this joint venture for FTAI. How does that work?
It's a two-way street that provides a real structural superiority. First, for their own MRO business, FTAI gets 5 specific, high-value hot section parts at cost.
At cost.
At cost. This translates to discounts of up to 75% compared to what a typical competitor would pay buying from the OEM.
Wow. And the second part?
The second part, and this is crucial, is that they earn 25% of the profits when these same PMA parts are sold externally to third parties. That second revenue stream is pure, high-margin income that very few peers can access.
The FAA certification process is incredibly rigorous, which is what creates that barrier to entry. What's the current progress on getting these key parts approved?
So the first part received FAA approval this year, which was a major milestone for them, both operationally and for investors. The second part, which management has noted is actually the most valuable, representing about 60% of the value of the first two combined, is expected to be certified in Q1 of next year.
And the rest will follow.
The remaining 3 will follow over the next 12 to 18 months.
Let's connect this back to the financials. If they fully integrate all 5 of these PMA parts, the cost reduction is staggering. Sources suggest the CFM56 overhaul cost drops from around $6 million down to $2.5 or $3 million per engine.
Yeah, it's a huge drop.
Cutting maintenance costs in half. How does that translate into JAP accounting and their pricing power?
That 50 to 60% cost reduction, it translates into immediate value accretion in 2 big ways. First, on the balance sheet. Every engine they own and overhaul immediately sees its book value increase because the cost basis for all future maintenance has just plummeted.
So a non-cash boost to asset value.
A fundamental non-cash boost. And second, operationally, it gives them unmatched pricing power. They can offer maintenance solutions to airlines that are substantially cheaper than the OEM equivalent and still maintain structurally superior margins.
And that cost advantage becomes a real competitive moat that someone like GE or Safran can't really replicate without fundamentally undermining their own highly profitable OEM parts business.
Exactly. They are disrupting the OEM's main profit center by providing a cheaper, equally certified alternative that saves the airline money, makes the engine a more valuable asset for FTAI, and provides a new revenue stream through those external parts sales. It's brilliant.
Okay, that's the cost cutter. Let's move to pillar 2, the speed advantage, or what they call modular MRO capabilities.
Right. This addresses the other half of the airline headache, downtime. MRO is handled through their specialized facilities, like the Quick Turn Engine Center in Miami. And their innovation is modularity.
So instead of treating the whole engine as one big project.
Exactly. Instead of treating it as one unit for a heavy overhaul, they break it down into key modules, the fan, the core, the turbine, and they maintain an inventory of ready-to-go, fully serviced modules.
So if an airline just needs a fix on the core, they don't have to wait for the entire engine to be disassembled and then rebuilt. They just get a module swap.
Precisely. And this allows for radically faster turnaround times. The sources note that this modular exchange approach can be completed in just 5 to 25 days.
5 to 25 days.
Yeah. Now, compare that to the market average of 120 to 180 days for a traditional heavy overhaul.
That is a massive difference. Weeks or months of lost revenue for the airline.
A 150-day time saving is enormous for an airline managing thin margins and tight schedules. You're giving them the detail and completeness of a heavy shop visit, but you're doing it in the rapid window of a hospital shop visit.
It's the ultimate solution for predictability and speed.
It is. Their total annual capacity across all their facilities is currently rated at about 1,800 modules, with a near-term goal of executing 750 modules in 2025. This emphasis on inventory and speed is a huge operational lever for them.
Okay, finally, pillar 3, the waste-nothing philosophy, which is focused on optimizing used serviceable material, or USM.
This is critical for maximizing the unit economics of every single asset they acquire and tear down. When FTAI overhauls an engine, they demand incredibly high specifications for the parts used in their rebuilds.
To maximize the engine's residual life and value.
Right. So what happens to parts that are still perfectly functional but don't quite meet FTAI's high internal spec? They aren't junk, but they aren't brand new either.
They're classified as used serviceable material.
USM, right. And they are not scrapped. FTAI has a partnership with AAR, which is a large public parts distribution company. FTAI consigns those USM parts to AAR, who then refurbishes them and sells them through their global network to other aircraft operators who might have less stringent requirements.
So this is like the final essential step in that vertical integration loop.
It is. It ensures FTAI extracts the maximum possible salvage value from every asset teardown, turning what would otherwise be a sunk cost or just scrap into an enhanced revenue stream.
Yeah.
It just cleans up the remnants, driving even better unit economics across their entire operation.
We've established the structural tailwind, the split, and the competitive moat with the MRE platform. Now we turn to the engine for future rapid growth, the Strategic Capital Initiative, or SCI. This marks a massive pivot away from their historical model.
The pivot is very intentional and strategic. FTAI is actively moving away from holding aircraft leasing assets on its own balance sheet. You can see that in the 30% decline in leasing assets versus 2024.
They're shifting to an asset-light strategy.
Exactly. They want to focus their own capital and resources on the high-margin MRE business, the parts and the maintenance.
So the SCI is the mechanism to keep acquiring the feedstock, the aircraft and engines, without tying up FTAI's own balance sheet capital. How big is this vehicle?
The SCI is a partnership designed to deploy capital specifically to buy the narrow-body aircraft that use their target engines, so the 737NGs and the A320ceos. And the inaugural vehicle was tremendously successful. It closed its fundraising in October 2025 with $2 billion in equity commitments.
Which actually exceeded their initial targets.
It did. And when you layer in the debt financing that capital can leverage, the scale is just enormous. Including debt, the vehicle is slated to deploy over $6 billion.
Upsized from an initial $4 billion target.
Right. And FTAI co-invests up to 19%, about $380 million. But their primary role is managing the partnership as the general partner.
So they earn those lucrative management fees.
Exactly. The target is to acquire approximately 375 aircraft, which means 750 engines for their platform.
Okay, but deploying $6 billion to acquire 375 aging aircraft, that seems inherently risky. I mean, what happens if the retirement cycle accelerates, or if the next generation of engines, the LEP engines, penetrate the market faster than expected? Are these assets truly protected from obsolescence?
That is the most important question to ask about the SCI structure, and the answer lies in the incentive alignment. The investors in the SCI, they aren't buying the aircraft primarily for the leasing revenue.
That's not the main prize.
No, they're buying them to guarantee the maintenance stream for FTAI. The aircraft are the bait, and the high-margin maintenance is the prize.
So the investors know they're buying older aircraft, but the critical differentiator is the guaranteed pipeline this creates for FTAI Aviation.
That is the core value proposition. The institutional investors who are committing the $2 billion, they agree to a crucial condition. All engine maintenance for aircraft backed by the SCI must go to FTAI Aviation's MRE platform.
It eliminates customer acquisition costs.
And it guarantees massive volume onto their high-margin platform. It's a closed loop.
So let's quantify the financial leverage this provides. How much predictable incremental business does this actually lock in?
Well, analysts estimate this guaranteed pipeline will generate around $250 million in incremental EBITDA annually.
Okay.
And this calculation is based on the assumption that roughly 100 shop visits will be required per year from that 750 engine fleet.
Yeah.
About 20% of the fleet needing major work, with each visit generating an estimated $2.5 million EBITDA.
And that's thanks to their superior PMA cost structure.
Exactly. That's what makes the numbers work so well.
So that is immediate, high-margin, predictable business conversion onto their platform. It essentially creates a guaranteed backlog for them. How quickly is the partnership ramping up?
Very quickly. Management confirmed in Q3 of 2025 that the partnership is highly active. 190 aircraft are either closed deals or under letter of intent.
With 101 already closed.
101 already closed, including the seed portfolio. This really confirms management's capability to rapidly execute on capital deployment. They could put the money to work.
And this is just SCI 1. The ambition is far bigger.
Oh yeah. Management plans to launch SCI 2 next year, and they've said they aim to eventually manage $20 billion in assets under management. The SCI model is not just a fundraising vehicle. It is the core mechanism for dominating the aftermarket by locking in their own engine supply.
Okay, let's get into the hard numbers from Q3 2025, because these results are the proof that the execution is actually matching the strategy. What stood out in the financial highlights?
The performance was strong, and it clearly showed the success of the pivot. Net income was about $114 million, which translated to a $1.11 EPS. That's up 46% versus Q3 of 2024.
A big jump.
About
And consolidated adjusted EBITDA.
$297.4 million. But the real story is in the segment breakdown.
Right. The high growth segment, aerospace products, was the major driver.
Absolutely. The aerospace product segment, which captures that MRE and parts business, it reported $180.4 million in adjusted EBITDA. That is a massive 77% year-over-year growth.
77%.
That percentage right there, it confirms the rapid adoption and scaling of the MRE services. It's working.
And digging into that, the MRE contract revenue itself was $59 million in the quarter, which is about 11% of the aerospace products revenue. This suggests that the guaranteed contracted SCI work is just starting to layer in.
Exactly. It signals a lot of future runway. And what's more, the balance sheet remains robust. They reported over $900 million in total liquidity, including an undrawn $400 million revolver, and net debt to EBITDA stood at a very manageable 2.5 times.
So they have the firepower to keep funding their co-investments into future SCIs.
They absolutely do.
And this confidence translated directly into raised guidance for 2026. What are the new targets management is setting?
They raised their 2026 adjusted EBITDA guidance from $1.4 billion up to $1.525 billion. And crucially, let's break that down. It comprises $1 billion from the high-growth, high-margin aerospace products segment,
$1 billion from that segment alone.
and $525 million from the traditional aviation leasing segment.
That division confirms the entire thesis, doesn't it? The higher margin maintenance and parts business is projected to be nearly twice the size of the traditional leasing income stream.
It confirms that the MRE platform is quickly becoming the dominant profit driver. They also increased their adjusted free cash flow target to $1 billion for 2026, which is up 33% from their 2025 target. This shows strong expected conversion of earnings into cash.
Now, we have to address the skepticism that inevitably follows such rapid growth, particularly the short-selling firm Muddy Waters, which published a critical report.
Right.
What were their primary claims? How did they suggest the growth was deceptive?
Their core thesis was that the growth was inflated by deceptive one-time sales and potential channel stuffing. They were suggesting FTAI was merely transferring engines internally to pump up the results. They also questioned how FTAI could be so much more profitable than the OEMs.
Suggesting optical profitability through their depreciation schedule.
Exactly. It sounds alarming on the surface.
It does. So how did analysts and the company refute these claims?
Well, the counter-arguments really center on the structural differences that the short sellers, frankly, failed to account for. First, the claim about deceptive whole engine sales was refuted by pointing out that whole engine exchanges, or three-module swaps, are not some financial trick. That is the core desired product offering.
Because airlines demand zero downtime.
Right. A rapid full engine swap is the preferred solution. What looks like rapid asset turnover to a skeptic is simply the speed of their highly efficient business model.
And what about the question of superior profitability?
That's explained entirely by the vertically integrated moat we've been talking about. FTAI's rapid asset turnover, 3 to 4 times faster than peers, combined with their exclusive proprietary PMA access, provides structurally superior margins that are simply not comparable to the OEM model. The short report just failed to acknowledge the cost basis advantage from that PMA joint venture.
And the criticism regarding the depreciation schedule.
That was addressed by highlighting that FTAI has maintained the same auditor, Ernst & Young, since their IPO in 2015, and they reaffirmed the 11 to 13% depreciation schedule on their short-lived assets. The policy is consistent and, frankly, appropriate for the rapid refurbishment cycle of the assets they acquire.
Okay, finally, let's talk valuation. Valuing FTAI is complex. They're this unique blend of a lessor, an MRO shop, and an emerging parts manufacturer. How did analysts approach this?
You can't use a single multiple. It just doesn't work. You have to use a blended multiple approach. You start by valuing the core leasing business, which historically might get an 11 times EBITDA multiple.
Okay.
But then you have to apply a premium multiple to the PMA and MRE component, which has the high margins and defensibility of a specialty parts manufacturer.
So you'd apply a multiple of, say, 15 or 16 times EBITDA to that part of the business.
It's exactly. More in line with companies like TransDigm or Heiko, which trade at much higher valuations. Even with the core leasing business alone generating around $500 million in EBITDA, that provides a really significant base and margin of safety. The true upside comes from the multiple expansion on that $1 billion projected EBITDA from the aerospace product segment.
So the optimistic view suggests that even with the stock trading around 175, as of the sources we have from October, it's still a growth at a reasonable price opportunity.
That view hinges on the market fully recognizing the integrated advantage and that structural catalyst. If the market justifies a multiple expansion from its current blended rate up to, say, 13 or 14 times EBITDA, analysts project that this re-rating, driven by the K1 removal and index inclusion, could imply very significant upside potential.
And Oaktree's re-entry is a strong signal that this multiple expansion is plausible.
It's a huge signal that this transformation into a high-growth, pure-play industrial stock is real.
This has been a true deep dive into a company fundamentally rebuilding itself in plain sight. What is the core signal we want you, our listener, to take away from this mountain of data on FTAI Aviation?
The core signal is execution. Execution on a truly differentiated, vertically integrated platform. FTAI has successfully combined engine ownership, modular rapid maintenance, proprietary cost-cutting PMA parts, and guaranteed growth via the SCI. It is strategically positioned for dominance because it solved the airline's biggest operational pain point.
Unpredictable downtime and cost at scale.
Exactly.
And the upcoming structural split, converting the company from this complex conglomerate into two pure-play C-Corp, that's the key to unlocking the broader institutional demand. Coupled with the aggressive, validated growth targets we saw in Q3, FTAI has created a unique confluence of structural and operational tailwinds.
And that transformation exploiting the modular design of the CFM56 to create a faster, cheaper, integrated solution that the OEMs couldn't or wouldn't provide, it raises an important question for you to consider.
As global fleets and capital-intensive assets across all industrial sectors, transportation, energy, manufacturing continue to age and cost pressures intensify, what other overlooked components or subsystems might be ripe for this exact kind of disruptive, vertically integrated modular business model? How can you spot these highly specialized, high-margin maintenance moats before they achieve 9% market share and attract institutional giants like Oaktree?
Think modularity, think cost differential, and think about the alignment of ownership incentives. That's the lesson FTAI offers.